Welcome back. Futures indicating a decline at the start of trading this morning. Take a look. Dow Industrials right now down 143. The NASDAQ is down 83 right now on this Friday morning. Markets so far this month also in the red. It's been a brutal month, actually, for the stock market. Take a look at the month of March, where the Dow Industrials are down almost 3%. The S&P down 3 1/3%. The NASDAQ down 4.5% for this month. And the year is also not good. Year to date, stocks are negative. The NASDAQ down better than 9% in 2025. Take a look. S&P and NASDAQ among the worst for the year to date. Joining me now is MacroMavens President Stephanie Pomboy. Stephanie, great to see you. Thank you so much for being here. You've been calling for a sell-off and sort of a reaction to what you've seen as a slowing economy and a macro story. What's your view of these numbers and where we're going this year?
Well, thanks, Maria. I think obviously I had talked for a long time about how extremely overvalued the markets had been by basically any valuation metric you wanted to use. You know, the simplest one is Buffett's favorite measure of the market cap to GDP, and we're at, 200%. The historical mean is 77%. So that suggested, and this is, that's pretty much been the math for the last year or so, that the market could get cut in half tomorrow and still be overvalued. And that sounds extremely draconian. But, you can't support these endlessly elevated valuations forever. And I think what we've seen for a long time is that we've kind of rotated the supports under the market from monetary stimulus, then to fiscal stimulus, and now both appear to be receding. And that's a problem for the markets. But I would say that the biggest number one factor here that's driving this is the impact of the higher interest rates that have been in effect for quite a while. But again, we're masked by the continued fiscal stimulus, which, Joe Biden had everything planned so that a lot of it would still kick in 2024. That's now all going out the window, and we're starting to see, the markets are having trouble sustaining these valuations. And obviously, it's not just the stock market, but credit spreads have widened out dramatically, reflecting the deterioration in credit quality with corporate ratings downgrades coming apace, not just in the high yield space, but even in investment grade now. And, rising default rates. And obviously, we've continued to see a parade of bankruptcy filings from, things like Hooters, which is kind of shocking because they, I know the wings may not be much to talk about, but the scenery was supposed to be a draw. And apparently, even that isn't enough to bring people to the table. So that struck me as a pretty big red flag that the consumers feeling pretty grumpy.
Yeah, that is a good point, Stephanie. Look, what do you want to do as an investor? I mean, you've talked about gold a lot on this program, and you've been spot on gold. It's in record territory. Of course, it's lower this morning, but it hit another record high yesterday after the Federal Reserve's rate cut outlook. Stephanie, your thoughts on gold? You don't see an overvalued situation here?
No, not at all. And actually, I appreciate you giving me the opportunity to talk about it because I get lambasted for being negative on stocks while they continue to move into deeper and deeper into bubble territory. But my preferred asset has been gold, and it actually outperformed stocks last year and has absolutely trounced them this year. And I think this is just the beginning of a broader move, not just in gold, but in hard assets relative to paper assets. We've seen multi-decade moves in paper assets with hard assets basically going nowhere. And these things tend to move in multi-decade phases. And I think we're now at a turning point where commodities and gold, those sort of assets are going to outperform stocks and corporate credit. And I would argue, gold has a lot driving this move. But we are now finally, for the first time, starting to see Western participation. The move in gold for the last couple of years has been entirely driven by this diversification by global central banks out of dollars into gold. And only in the last few weeks have we finally started to see some interest in, gold ETFs here in the United States. So I think this move has much, much farther to run. And so I remain steadfastly bullish on gold.
And any stocks that you would hide in this period right now?
Well, I mean, I think in general you want to be defensive. I would be long the consumer staples rather than the consumer discretionary space. I guess you could play in utilities to the extent that an economic slowdown is going to reduce interest rates. But generally, I like everything that's commodity related. So I'd be interested in energy stocks, gold miners, resource economies, their markets, for example. Okay. So I think there are opportunities out there. I don't know that I would be anywhere near the broad U.S. stock market, though, because of the preponderance of the Mag 7, and they're clearly struggling, and it's reflected finally in the averages.
Yep. Stephanie, great to get your take on all of this. Thanks so much.
Thanks, Maria. Have a great weekend.
And to you. Great weekend. Stephanie Pomboy there.